When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome back to MacroEdge Radio. This is John Galt speaking, free of the ick, ready to rant, ready to rock, and ready to roll. First, I'd like to thank everybody for our patience while we were down last week, but I would have sounded something like a cross between a dog squeaky toy and potentially a drunk Jim Cramer on the air, something we definitely do not nor want to hear. Let's get into a quick market review as the equity markets wind down on one of the more fascinating weeks. Right now, it looks like we're going to settle down about 114.81 on the S&P 500, 737 on the Dow, NASDAQ down 481, 2.7%. I would say that this week is ending and this month as an abject disaster. Russell 2000 down 44.50. 2000 is now in play. All hell will break loose. Commodities, oil down 80 cents, Brent down 81. The Widowmaker up 15 cents. God knows why. Winter is over. Gold up $24, finishing for the first time ever above $3,100 on a weekly close at 31.15.30. Don't want to say, see, I told you so, but we'll let that rock and roll. Silver down a little bit, 29 cents to 34.79. Copper basically flat, down a penny to 5.10, 5.11. The more interesting aspect of the market has been the treasury market. And if you've been watching it, we had a very eventful night that most people don't pay attention to because most of you are smart enough to not get up at 4:30 in the morning like us crazy people. The 2-year finished the week down 8 bips at 391. The 10-year down 11 at 4.257. But the 2-month and the 1 month took a serious spike higher in the middle of the night as somebody in Asia, rumored to be in Japan, had a cash call and had to liquidate U.S. treasuries at an incredible pace to the point where the 2-month reached a 5.1% yield. That's not Uncle Bob and Aunt Jemima sitting here trying to liquidate for the sake of liquidating. It is a god-awful, serious situation where there are problems in Asia that we can't see, and it's a dollar funding problem. When you have to raise dollars like that, the world is getting a little unsteady. But tonight's guests are fantastic. We have Melody Wright and Ulysses Awsumb. We're going to talk real estate and macro because more so than ever, they are married together. But let us sit here and bring them on. Melody, welcome aboard. Mr. Awsumb, welcome aboard.
Hey, John, can you hear me?
You sound fantastic. It's good to hear your voice.
Excellent. You too. Thank you.
Hey, John. Hey, Melody. How are you both?
Oh,
good. How are you?
Welcome aboard, Mr. Awsumb. Well, folks.
Glad to be here.
Well, Melody, you recently had an adventure in California. If you'd like to share with the listeners, boy, I tell you, that was some great reading, by the way. If you're not following Melody on Substack, I suggest you do so. Melody, share what you discovered out there, which is unfortunately what we suspected, and what the implications are for the real estate market as far as that's concerned on that coast.
Yeah, so John, I think I'm still recovering from that trip. It was pretty brutal, and it's I'm still processing all the things that I saw out there. But you know, a lot of times we look at the data, we look at the information that we're getting, and all we can do is really synthesize it, triangulate it to get a picture. But you know, these boots on the ground trips really put things into perspective. And so everything that I thought about California is actually way worse when I got there. And what was I thinking about? California, you know, I was looking at the labor picture, just watching it deteriorate. I was looking at inventory really exploding. And I've been talking about California's sales being abnormally strong since really early summer. And so basically when I got there, everything that I thought might be happening, which is that we were starting to see motivation, extreme motivation in California turning to distress. And I think that this is where demographics are so important. And we just, I think part of it has to do with the fact that we get that information so delayed. But there's been over almost 389,000 people who have left Los Angeles since 2020, and you can see it. And that's over 119,000 households when you look at the average household size out there. But I can tell you, John, when I was driving on the 405, I did not know where I was. I mean, my entire life I've been going out to LA. I've been on that road on a Monday at 2 a.m. I've been on it on the weekends, and it's always packed, and it was not. It was a weekend. It was the weekend before the Oscars, and so maybe people were staying off the roads. I kept trying to rack my brain. There were moments, John, on the 405 where it was wide open. What do I mean by that? There wasn't cars in front or behind me. And what is it, like 8 lanes, 6? I don't even know. And so it was just very wild. Now, the other thing that we wanted to see was, okay, what are the fires? We've been hearing about bidding wars. We've been hearing that, everybody, Carlsbad, Newport Beach, everybody was going to be able to sell homes because people from LA were going to flee there. Well, that wasn't bearing out either. And what we kind of saw in the weekend traffic and like open houses, we saw a ton of for sale signs, not a ton of traffic. I think that everyone in LA is looking for one very specific type of home, and that's where you get the bidding wars, and that's the 1 to 3 bedroom home, that the ever ephemeral in LA. But in reality, there's tons of luxury setting, and what really isn't luxury but is overpriced is also sitting. And so basically California is a housing market in distress when most people that you talk to will tell you that it's doing just fine. Prices are never going to go down. But those folks are delusional, and they're not paying attention to demographics, and they're not paying attention to the labor situation. So I'll stop there. Well, quickly, I'll just say, what you can see in the labor situation is that the only jobs that are really holding up out there are those to service the rich, or those to service the addicted, the homeless, or the folks in detention centers. That's the private education and health services category. And so, when Travis and I were in San Diego, we went to go visit the O-Lot, which is a overflow parking. It was a parking lot in the old Navy Center. This is where they have all the homeless in these tents. And that organization that is running it got a government contract for about $2 million last year. That is their whole budget. And so you can see that a lot of the jobs still standing are those that are funded by these public-private partnerships with, for services like to assist the homeless. And so I know that was a lot of words, but I can tell you that California was just a very stark picture of exactly what's wrong with our country right now, and what's left from a jobs perspective. And it illustrates that there's just no way we can sustain these home prices.
Well, that brings the next question. Is this starting to look more like the Florida, Texas, Arizona markets that we've been discussing in our previous appearances together? Or is this looking more like something far worse, more advanced down the road, where you have that small clique of upper middle class homes that are still moving, but the entry level homes aren't available? So that's all that's going to move for the foreseeable future.
Yeah. So I think a little different from Florida and Texas in terms of what's driving a lot of that is a lot of that new build, right? I mean, a lot, but there's plenty of existing too. Don't get me wrong, but there's just so much speculative new building in Florida and Texas. Is it going to matter what's driving the issues? Not really. I mean, California is our largest housing market, and when it goes, that is when delusion tends to let go. And then, finally, the Northeast will really sink the deal. But California turning is huge, and I believe that we are at the point, there are plenty of people that still want to deny it, but the California housing market is turning like the Florida and Texas market, but very different things are driving them. What's driving California is just rot. It is just years of delusion that it's now coming home to roost. There is no one there that can afford these homes. And you take San Diego, for instance, you look at Mission Beach, it's just all short-term rentals everywhere, but not enough people can come there to stay. And so and San Diego is number 2 in the nation behind Miami for speculation still. But if you look at the job situation out there and you look at the homeless situation, it is very hard to imagine why anybody would be investing in San Diego right now. And then tack on the government.
Go ahead.
We'll tack on government adjacent contracting jobs, right? Like San Diego has a huge military presence, and there's a ton of services and a lot of defense contractors. They're going to definitely be impacted. So it's just a city that has changed so significantly, and most are completely unaware of how much it has changed.
I was afraid you were going to say that, because what I noticed this week in a small blip that was published is since the fires on the Pacific Coast, only 12 permits have been approved for rebuilding, which is, you look at Florida or Texas, you would see a dramatically larger number of permits reissued, and of course repairs, et cetera. I mean, we have our problems down here. I'm not about to sit there and tell everyone that the hurricane recovery has been even by any stretch of the imagination, but at least there's an effort to get people back into their homes and move. From what I understand out there, government is more of obstruction, not just from the perspective of home rebuilding and approvals, but also just making basic improvements to make homes sellable.
Yeah, it's absolute insanity, John. And I think when you talk to people out there, there was a lot of lip service initially about fast tracking permits, but for anybody that does business out there, you knew that I have a lot of clients out there. You knew that would not, that wouldn't really happen. But I saw the number was 4, but 12 might be right. But the point is, even still, even if they could rebuild, I mean, the destruction in Altadena and the Palisades is so much that you're talking about. You don't want to be there. I mean, even in Altadena, we were there, 6 weeks after the fires. My head was hurting, stomach. I mean, the toxicity in the air. There is no infrastructure. There are no schools. But let's not forget, Altadena, the Pasadena school system was already, I think, a massive budget deficit, and they were laying off teachers, and this was before the fires. And so I think the fires are covering up just how much trouble is out there. And I don't think there is going to be a ton of rebuilding, because honestly, I feel for the people that were left standing, because they are just surrounded by destruction. I mean, I don't know who's going to be there, and once they start constructing it, it's going to be a nightmare. But you're already hearing about people selling their lots. But to me, I then look at Fort Myers, John. After Ian, we heard the same. Everybody was buying those beachfront properties, that were decimated because they wanted the land. But at the same time, insurance rates were going up, and people looked and were like, oh my God, what, to develop this and insure it is going to be crazy. And so now what you've seen is just, exponential increase in inventory there, as well as precipitous drops in sales and prices. So I really think that is likely the fate of LA. It's just, and there were themes already driving us there. The fires are going to mask it for a little bit, but then reality is going to be apparent by the middle of the summer.
Well, this brings us to some new macro reality. I'm going to bring Mr. Awsumb up real quick. Mr. Awsumb, you and I have been talking about through our regular chats. So there's some news this week that the FHA is restricting loan eligibility to U.S. citizens and permanent residents. There's news of apartment loan delinquencies accelerating, surging 39% in Q4 of last year. And then what you and I were discussing, which really is a little more disturbing than we're talking about, $79 billion in home builder equity share, home builder share equity that's been wiped out. At what point do we start seeing price reductions? Because it seems price is holding, mortgages are stabilizing above 6.5%, but we don't seem to see any movement and we'll talk about the student loan fiasco and everything else, to sit there and absorb some of this excess capacity?
Yeah. So I guess I'll touch first on that, the pricing, at least on the new home front, because we have actually been watching new home prices contract for going on 2 years now. One of the things that the Federal Reserve and U.S. Census Bureau track is not just the median and average sale prices of new houses, but also by financing type. And if you go from conventional financing, back in Q3 of 2022, the median sale price through conventional financing, which makes up 3/4 of new home buying market, was at $494, and it has gotten all the way down into the low 400s over the last few months. And you've got public home builder execs that are now speaking in earnings calls saying that they're going to continue to have lower prices. In fact, the co-CEO of Lennar, Stuart Miller, just was talking about the fact that they're in a negative price environment on the earnings call, and they're going to have to continue to work both with incentives. So buy downs, and Lennar is actually applying 13% of their median or average sale price of a home as an incentive while that price is contracting already. And we're starting to see it. We talked about it a while back at MacroEdge. We published an article back in October making note of the fact that XHB had reshuffled its holdings and cleared out home builders out of its top 10 holding spots. And since then, the average share price value of the 20 largest publicly traded home builders has seen a 34% decline in share value. So amongst those 20 builders, that's $79 billion plus in share equity that is just gone. So I think that's part of what we're starting to see in the earnings calls and what they're talking about.
But can they sustain it? Because these incentives, at some point, your margin squeeze is beginning to accelerate also, as admitted by KB Hones this week.
Correct. So one of the things that I expect is, as we see this spring market has been very soft, and if it does not start to pick up materially, basically right now, March, April, because this is typically the strong point for them, then I think we may finally see some weakness in the construction employment sector going into the second quarter and third quarter of this year. As you pointed out, supply, and Melody spoke about it, we're back to 500,000 single-family homes for sale, which has only happened one other time in history, and that was in 2005, going into 2007. For 2 years, we had over 500,000 new single-family homes for sale. And I'll throw some charts in the chat for everybody, but the two big components there are spec homes. And those are the homes that are both completed and the homes that are not started. And for everybody listening, why I include that is, as a builder, that home that is not started, that's a finished lot that you have permitted for a specific house, meaning only that type of house has been listed for sale, and only that type of house can be built on it without having to go back and re-permit that property. So it's starting to show signs of material weakness in home builders, and I don't know that unless we see some drastic change in mortgage rates or improvements in incomes really quickly, I don't think there is a quick resolution. I think it's just going to continue to weaken until we get back to a price point. My thoughts on that are, once builders reach around $330,000 to $350,000 median sale price on an average across those builders, then we can start to see the situation improve.
Well, knowing your background in commercial, let me ask you a question about the distress rates and the problems we're seeing in the apartment. It would appear in some of these formerly exploding markets we've seen increased distress in commercial real estate for apartment complexes, multifamily. If this accelerates and we see a decline in quote unquote immigrant population and more of the Gen Zers having to move back in with mom and dad, which is a reality we're beginning to witness. Do you or do you not feel that this could become a major issue for enhancing and expanding delinquencies in the multifamily arena?
Yeah, absolutely. So one of the things that helped us get to the point where we have built more apartments than any time in recorded history over the last couple of years, which we have, we can actually trace that back to opportunity zone legislation that was passed in the prior Trump administration. And by all measures, it was a wildly successful endeavor because it helped spur investment in real estate. However, we now have a lot of apartment supply coming online, and rents have stopped increasing greatly across the nation. And combined with the cost of money, it's no surprise that we're seeing some of these projects and even new ones, or some of the projects that were bought that are maybe 1960s to 1980s vintage, under speculation that rents would continue to increase or that they would be able to refinance short-term debt on these at a feasible interest rate. And so now we're starting to see the effects of those not coming true, right? They're not able to refinance at interest rates that they had figured going into those projects. And we've got the combination of all the new supply of apartments coming online. So you've got basically brand new apartments that are giving away in many markets anywhere from 1 to 4 months of free rent. So we're seeing some softness there, but it's to get the apartments leased up so that they can continue to perform. So I think we're in an environment where we're going to see more of that softness going forward as well. Any economic policy that gets put in place, it's not going to be an overnight fix. So, my timeline is this year we're going to see even more softness, and we're not going to see any material improvement there until at least next year. We probably have another 400,000 to 500,000 apartments brand new apartments coming online this year as well.
Well, we've seen no slowdown in the building in Florida. I'm sure the same situation could be said for Texas. And California, I'm sure, still hasn't stopped the projects because there was an anticipation of another wave of people. Melody, let's bring you back up here. This is more into your ballpark and to Mr. Awesom's. When you see the distress level starting like this, I don't want to compare it to 2007, but if it looks like a duck and it quacks like a duck and it waddles a duck, it sure does seem familiar as far as the distress levels on commercial real estate for multifamily and on the residential real estate as far as single family homes and the distress that the lower income to lower middle income strata is enduring right now.
Yeah. So, John, I think we have to be able to look back and make some comparisons. And something that I did in my Substack a few months ago is I wrote something called Baseline because I wanted everybody to understand, just to give you perspective, by the time that we got into an earnings in, say, 2008, our subprime book was less than 12% of our entire portfolio, and that was around a 6% delinquency rate. And we were one of the biggest subprime lenders in the country, but we had already pivoted to government lending by that point in the cycle. So let's take where we are today. You have your FHA, which is anywhere between, depending on the quarter, between 13 to 15% of the outstanding mortgage market right now, and that is already over at a over 10% delinquency rate. Okay. You then also have your VA, which is another, say, 5% of the market, and they are at an accelerated, I think, 5% delinquency rate, something around there. And then you have the private market. These are the people that do what we call non-qualified mortgage. These are your DSCR lenders for short-term rental and things like that. That's only about 3% of the outstanding market, but that is at a 12% delinquency rate. So you're talking about over 22% of the outstanding market already at accelerated delinquency rates. And so when folks say that, it was just subprime last time, we know that's not actually true. Subprime started the fire that became a collateral issue just like you were saying, John, somebody somewhere, there was a margin call. Lehman couldn't, essentially Chase told them no more. And you had, a liquidity issue and a credit event, which last night could have been the beginning of something like that. So that's what the subprime issue was. But the lion's share of our foreclosures and default actually happened in the prime book. And delinquency peaked in 2010, much later than what we think of as the GFC. And so we are already seeing significant signs of distress. And, once we start to see the credit scores impacted, and you mentioned this, from what's happening with student loans, and that could already be happening, and that's probably why the Fed just reported an over 41% refinance rejection rate, mortgage refinance, meaning that 41% of applicants who are trying to get a refinance, which at these higher rates means that they need that equity, they need to access that cash, were rejected. And I only think that's going to increase because we know credit scores were inflated. So even on that prime Fannie and Freddie book, I don't believe that it's as good as people think. And then Mr. Awsumb and I have discussed this, and he did a good analysis that even when you look at the debt to income ratios and what they were back during the crisis on the Fannie and Freddie book, we are right there again. And I don't know.
100%. Yeah.
Yeah, go ahead if you want to say something about that, Ulysses.
Well, I'll just add to that we're literally right where we are, both on a debt to income for Fannie Mae, 38.1% average origination debt to income in 2024 versus 39% in 2006. And credit scores are basically identical, 720 to 790. And then what's worse now is the loan to value now for Fannie Mae or 2024 originations is higher than it was in 2006. Just to add to your comment there. And then the other thing I wanted to highlight about what Melanie said on student debt, that's also coming about basically at the worst possible time for real estate sales, for residential, both for builders and for people selling, because now you have the spring selling market and a big impact in people's ability to qualify for credit. And to your point, seeing 40% rejection rates on refinance, we're probably going to see that in origination also.
Well, I want to bring Eric, and if I butcher your last name, I apologize. Eric Basmajian of EPB Research. If you're not following him on X, I strongly suggest you do so. Eric, looking at the macro picture, if you have any questions for Melody or Mr. Awsumb, please go ahead. Is not the macro picture at great risk as we see the student loan credit reports declining rapidly and slowdown in quality of job creation, not job creation in numbers, but the quality of the jobs and income that's coming with it, starting to impact the real estate market and other markets also?
Yeah, well, first of all, good job with the last name. I get all kinds of pronunciations, as you can imagine. And I apologize for jumping in and out of the space. I got disconnected as a call was coming in. In terms of the broad macro and real estate and how the student loan, is playing into it, I track various sectors of the economy in a sequence because the way that the cycle develops is it always has a different it always has a different catalyst, so to speak, every business cycle, but it always follows the same sequence or order of operations in terms of the sectors that sort of fall as dominoes, whether that's the broad economy in terms of production or in terms of employment. So we're seeing some very early stages of the labor market deteriorating, but it's still pretty marginal in the sense that what we're seeing now is a shift from full time to part time labor, some reductions in temporary help, and some declines in some very small marginal categories like trucking and transportation. The real big sectors that need to decline that come very early in the sequence are residential construction or residential building, as well as manufacturing. Manufacturing has had some small declines, but they're extremely minor in terms of the magnitude of job losses that normally come during larger business cycle downturns. And when you take the two of them together, manufacturing and residential construction, we still have virtually no decline in terms of aggregate numbers there. And it's very difficult for the economy to have broad credit stress without having the actual number of employment drop. It doesn't have to drop in the aggregate numbers like the total non-farm payrolls that we see the first Friday of every month, but it does need to drop in terms of raw numbers in these more cyclical categories like the narrow parts of construction and manufacturing. And we're still not seeing enough yet to cause broad credit stress, although we are seeing some signs of marginal weakness, like the hiring rate is way down, the quits rate is way down. All of that symptomatic of the fact that the labor market's cooling pretty dramatically, but we're still not seeing a big jump in layoffs. Even in those more leading cyclical sectors. So we're still trending in that direction, although we're still pretty early in the labor market deterioration. So I wouldn't expect broad credit stress to hit just yet, even with some of the things like student loans coming back online. It'll create a little bit more pressure, but until we see those raw numbers come down in some of those earlier labor market sectors, it's going to be more of a slow bleed versus sort of a snap or a credit event that we have to be more careful about. I still do think that's on the way, but I think there's a few more dominoes that need to fall before we get there.
That's quite terrifying because from where I come from, since I'm the old guy in the room, the 1970s experienced stagflationary cycles where unemployment would range in the 6% range, and you would still have some sustainability in manufacturing, but the declines, when they did hit, often coincided with contractions in the economy and spikes in inflation. Are for the first time in forever, I'm hearing all of the financial television networks bring the stagflation word out. We've been beating that drum since last year. Do you think that is a greater risk for the Fed's ability to manage this economy and with the fiscal irresponsibility, and a bigger risk to the employment picture, which of course has implications for real estate, auto loans, et cetera, down the road?
Right. Well, I just want to clarify and put some numbers to the topic that you just mentioned there. I'm not talking about unemployment in terms of the broad U3 unemployment rate. That always moves very, very late, and like we're seeing now, that can stay low, and you can have issues occur before you have a big spike in the U3 unemployment rate. What I'm talking about is, again, the narrow categories, the cyclical categories of the labor market. So in 1970, for example, in that recession, you lost 6% of the labor force in residential construction and manufacturing. If you take those two categories and you put them together, you lost 6% of total jobs in the 1970 recession. You lost 25% of jobs in those categories in the 1974 recession, and you lost 20% of those jobs in the 1981, 82 recession. So even in these 1970 recessions, you lost somewhere between a fifth and a quarter of all jobs in these narrow categories of labor. I mean, those are huge labor market declines, only exceeded by 2008, where you lost 30% of the labor market in those narrow categories. And we sit here today down about 0.3 when you take those categories and put them together. So that's why I'm cautioning my comment about how advanced we are in the labor market decline. Is we've had many times in the past where these narrow categories, which move before the broad aggregates, decline 10, 15, 20% in total. And we're not even down 1% yet on those
Yeah.
categories.
So, Eric, in your analysis, do you look at kind of the quality of that? Meaning, we know that there is a ton of non-foreign born labor in the construction sector. Have you looked at kind of those relative levels in past periods?
Yeah, I mean, let's just look at aggregate income. So we just look at the total number of jobs, then we just look at aggregate income in those categories. So jobs times the amount of money that's being made. And I think you're running at like 4% nominal in the manufacturing and construction space in terms of aggregate income. So you're still growing income in those categories. And again, you have declines in income, aggregate nominal income in those categories that precede broader business cycle recessions. Now, I'm not saying that I'm not negative on the economy or the trajectory of where we're going. The economy is certainly slowing down. These cyclical sectors are slowing down. We were growing employment in these categories at 9-10%, of course, in 2021 and 2022. Now we are fractionally losing jobs. So that shift or that rate of change is absolutely there. Um, but you were losing jobs pretty aggressively in these categories as early as 2006. You were losing jobs in these categories as early as late 1999, early 2000. So generally speaking, you see the raw number of jobs in these categories decline somewhere between 8 to 16 months in advance of when the official gray bars come in. We have an unusual situation going on in these sectors right now, where if you look at the production of these categories, so when you take a sector of the economy, there's production. So what is being produced in those categories? If it's construction, how many houses are you producing? Or if it's manufacturing, how many widgets are you producing? So when we look at production in the housing sector and production in the manufacturing sector, they're falling pretty precipitously. Take them, the two of them together, we're falling at about 10%, from peak. So production is declining really sharply in these categories, but the employment associated with that production is not coming down. So by definition, I think I heard in the beginning of the call, what does that mean? It does mean margins are coming down. If you have production falling, but you're maintaining your headcount, margins are going to come down. And that is what's happening. But what happened after the pandemic was there was such an explosion in margins. If we look at the 8 home builders, for example, you take the average of the 8 home builders, 2019, their average operating margin was 10%. After the pandemic, that increased to almost 20%. They doubled their operating margin. We've gone from 20% to 16. So we're trending down. Margins are getting squeezed as production's coming down and they're holding headcount, but we're still 600 basis points above where they were in 2019. So they're doing things like cutting hours, trying to shed some temporary help. They're doing all freezing hiring. You see quits coming down. We're seeing all of the early stages that precede declines in headcount. But I really would want to see declines in raw headcount in these categories before I'd be more worried about a very proximate near-term credit event stemming from labor market weakness.
Well, but what are you defining as a credit? I think we're not defining credit event the same way. What do you mean by credit event?
Broad credit event being defaults, delinquencies that ripple and spread into other categories that are uncontrolled in a self-reinforcing spiral. So downward pressure in employment that leads to less income, less consumption, less production in a reinforcing loop that requires outside intervention to stop a self-reinforcing process.
Yeah, and when I'm referencing credit event, I'm talking about something more out in the broader market with collateral and liquidity. So not necessarily that the defaults in this sector would create a credit event. In fact, I'm not making that argument at all, just to be clear.
Sure, and to be clearer here as well, I missed a large part of this conversation. I sort of jumped in late here, so I didn't really hear your part. I was just answering the question from my perspective, but I wouldn't disagree with you if that's your definition.
And Eric, that's no problem because go ahead, Melody. I'm sorry.
No, you go ahead. Go ahead.
What I was going to sit there and say is, with the gig economy and the failure to index unemployment claims to inflation, because let's face it, if you lose your job in Florida, your maximum benefits are $275 a week. Well, what idiot would apply for that when you can make $500 a week delivering pizza and hauling old people all over town? I think that tends to distort the data, even in U6, which is my primary analysis. And I don't think that we have an accurate measure of our data, Eric, that sits there and brings forth the stress on the sub, let's say, 75,000 earning family category versus the distortions created by higher incomes receiving bonuses and continuing to enjoy it and enduring inflation just fine. That really does create a distortion because the people who were given mortgages when they were making $80,000 a year now earning 40, they're not going to be able to service them forever, just like auto loans and everything else. That's why I see the distress because of what occurred last night. That spike in the 2-month and the 1-month treasuries, especially the 2-month over to 0.5 up to 5.1%. That's a foreigner raising cash, raising dollars. We're starting to see cracks in the credit system that I think are going to have long-term implications, especially when it comes to MBS, because the first thing foreigners are going to liquidate in a trade war is our mortgage-backed securities.
You could be spot on about that. I'm not aware of what happened in the Treasury bill market. You'd be much more well versed on that than I am. The only comment I would make about the initial jobless claims is that um, there's pretty good research from the BLS as well as private, and people can run the correlations themselves as well. Initial jobless claims. The two sectors that have the highest propensity to file initial jobless claims are construction and manufacturing. So it does somewhat tie out that construction and manufacturing, as reported by the BLS, aren't declining super hard in aggregate, and initial claims are sort of acting somewhat similar. They're leaking higher, pretty slowly. So um, I'm not as pessimistic on the quality of the initial job claims data. What I see is that they're moving higher at a slow pace, directionally slowing down, directionally moving in a bad direction, but pretty consistent with what we're seeing from the BLS labor market reports, as well as pretty consistent with the data that comes from the JOLT series. So when we look at the JOLT series, we have um, job openings, we have hires, we have quits, and we have layoffs. And what we're seeing from the JOLTS data, you could parse out just what's happening in the construction and manufacturing sector, which is what I like to do. I think that's the perfect description of what's happening in the labor market right now. The quits rate is extraordinarily low in construction and manufacturing, which means that the people in those sectors do not want to leave their jobs because they know that they can't go get another job. The hiring rate is at 2009 levels for these sectors, meaning that these companies will not hire new people. That's a preemptive measure before you lay people off, is you freeze hiring. So because they've frozen hiring, people that do have jobs won't quit and go change jobs because they know they can't get one. The job opening rate has also fallen extremely significantly. But the last piece of the puzzle that hasn't moved is the layoff rate in these sectors is still almost at all-time lows in the construction sector. It's leaking up in the manufacturing sector. So I think that a lot of dominoes have fallen, and I'm pretty confident. I agree with all the panelists here that the direction of travel is still in the wrong direction. But I would want to see more concrete weakness in the raw number of jobs in these categories. Before I guess just using Melody, my definition that the process becomes a little bit more self-reinforcing, that requires an outside intervention to stop.
I just want to
Eric, thank
highlight
you
on
so.
that.
Go ahead and jump in, Mr. Awsumb. Go ahead, sir. Go ahead.
I just wanted to highlight that December of 2024 was the second lowest hiring rate for residential construction in the JOLTS data series of the 21st century.
No doubt.
So,
no doubt.
As far as the margin compressions, you've got companies like Lennar that are back to 10%. So, my point being, we're at the beginning of these builders starting to feel these pressures, and not saying that it's a credit event. It's a bad time for 40% of mortgage applications to be rejected when this is the strong season, typically for builders and for home sales. And
Correct.
that is a recipe for further reducing sales, furthering the bad data.
Right.
Agreed. Yeah, I agree.
All right. So, Melody, I'm going to bring you back up on this because we're going to go right back into your ballpark on credit. And this is one of those things that really is disturbing. The trade war is basically being ignored and played down as Trump's bluster, negotiating tactic, et cetera, et cetera. However, the reality is, and I mentioned this with Eric, if we see this trade war go from an 8 to a 9.5 or a 10 on the volume control, The first thing people will do to liquidate assets, I would think, would be getting rid of long-term U.S. Treasuries and mortgage-backed securities, whether they're commercial or residential. Isn't that what we sort of saw in 07, 08 to start the crisis and accelerate it, creating problems for the regional banks and some of the other major banks?
Well, I do think this is a little different in from what we saw then, but yes, John, I believe that we're already seeing this kind of stress, at least in not as much active purchasing. I think it's going to be, I think, it's not easy sometimes to unwind because these MBS are used like tokens to pledge as collateral all over the world for all kinds of crazy stuff. And so I don't think that like Japan wakes up tomorrow and just starts selling all of its MBS. But I do think that there's going to be less and less and less of an appetite, and folks trying to kind of exit their position because they might not trust what's happening in the United States. What concerns me more on the MBS, honestly, John, is what's going on politically, or kind of the drama at FHFA and in HUD, and what we're seeing, and things like we might change the conforming loan limit, even though Pulte has come out and said he's not going to do that. Things like we might take the agencies out of conservatorship. Maybe we'll put them in the sovereign wealth fund. This is just a lot of uncertainty in a giant market where I think people could start to get a little nervous about what's happening there. And that could be very disruptive in the housing market. I'm not discounting what both you and I think could happen, and I agree that it could, that foreign governments could become active sellers of these MBS or more aggressively. But I'm more concerned with domestically what that could do to the MBS market, if that makes sense.
That makes perfect sense, and I'm going to bring Kenny up in just a minute, folks, because we've got a lot of great speakers who are jumping in from the MacroEdge team in addition to Eric. What I wanted to also observe is there's a threat that Moody's could downgrade our credit rating again. And is that not a domino effect that goes right down to the agency debt level?
Yeah, I would think so. I guess what I'm saying is that this is, I'm more worried about like how this debt has been rehypothecated, John, than say maybe the primary market from global creditors. But yeah, absolutely, it could throw a real it would be very disorderly. But agency MBS is so, it's so critical to the entire global liquidity game that it would take some time to really unwind that. I'd be more worried about how that's been rehypothecated and derivative markets.
That's my bigger concern.
Yeah, exactly.
There you go. I was going to be ready to mention derivative markets also, because apparently there is a huge CDS book being carried by some of these banks that looks quite unhedged from the naked eye.
Right.
We can't see everything, and we can't see what private equity is holding either. And apparently non-financial business investment, NFBI is the new catchphrase for everyone in the banking business, has become a threat, with people observing that if they start defaulting and seeing credit deterioration, they'll sell whatever they have to survive and satisfy their investors. That's sort of terrifying in more ways than the previous crisis.
Yeah, and I would say that, generally speaking, I think I'm way more worried about all of that leverage out there and rehypothecation, which I feel is much larger than what it was previously. And I'm very concerned about what could happen in those markets, more so than, say, your core agency MBS market. Those, I think, will come under stress if this drama continues with the FHFA and people start to worry about what those MBS could be worth in the future. And that would be more, in my opinion, not necessarily on a valuation side, but on people being willing to buy MBS, which in turn would then mean mortgage rates would go higher.
Thank you, Miss Melody, for that clarification and answering my question. Kenny, welcome aboard. Kenny is part of our real estate team here at MacroEdge. Kenny, please bring us your perspective from what you're seeing. You're a resident of one of the hottest markets, Nashville. And Tennessee has always been a little bit like Florida, except you don't have the worst drivers in the world. We got that cornered. Please fill us in on what you're seeing, especially from the employment perspective, because you've had some recent commentary about that, and it ties into what's going on. We had a discussion with Mr. Awsumb, Melody, and Eric previously.
Yeah, so yeah, Nashville is definitely like the redneck Disneyland these days. And the COVID stimmies seem to be wearing off, no doubt. I mean, today they actually came out with the state area employment metrics, which basically it's like think non-farm payrolls at a state and local level. And I want to say for Nashville, it came in at like 0.5%, not seasonally adjusted year over year, which is basically what it looked like in 2001 and 2008. And so, I mean, things are definitely slowing here quite quickly, I would say, compared to previous cycles. I think that's probably going to catch some people off guard because we are not this like healthcare hub where we're just immune to the business cycle. It's just, we're just a much more cyclical economy these days. There were so many companies that like relocated here in the last true cycle, and they've already sort of done that. So yeah, it's not great here, but in general, I had like a couple of comments that I was curious if Eric had any sort of thoughts on, because when I look at something, because I'm not just looking at Nashville in isolation, I think that would be unwise to extrapolate just what I'm seeing here locally to the rest of the country. But when I look at something like the employment in construction, residential construction, especially residential building construction, is only just kind of like a fraction of like the entire residential bucket. Like the contractors within residential construction make up the majority of it. And I'm seeing like residential foundation and finishing contractors basically rolling over after what appears to be just like this enormous dead cat bounce after BTFP. And so, especially like when I look at the non-sampled version of that data, which is lagged, it just looks like those numbers, especially for residential building construction, are overstated. And so I'm a little cautious on those numbers. And I'm not suggesting that it's going to roll over overnight and there's going to be some major event. But on top of that, like I'm just kind of curious about the quality of the claims too, because the share of the unemployed actually claiming UI benefits is very low, really, in this post GFC world outside of COVID. So I was just, I just wanted to put that out there. That's all I really kind of had to say. But those are my 2 cents.
You make a good point about the residential construction sector. There's about a little less than 1 million residential building jobs, and residential contractors are 2.4 million. So it's certainly bigger, residential contractors. The data series on residential contractors only goes back to about 2001, I believe. The data on residential building goes back to 1985. Using some dynamic regressions, I've actually recreated the residential building back to the 1960s. But with that being said, with the limited sample that we have for contractors, the peaks and troughs, or the vectors in which they move, are highly correlated, residential building and residential contractors, which is why it's often that they're used interchangeably, and then you use the residential building generally because it has a longer sample. But you're right that residential contractors are larger by size. It peaked in September 24 at about 2.4 million, and we declined for a couple of months, and then we popped back in February. It's still sitting at 2.4 million. In total, it's down 3,000 jobs. So taking the data for what it's worth, it looks to be like it's rolling over. I agree with you there. I'm watching that extremely closely. If we take the data for what it's worth, residential contractors are down 3,000 from peak. And for context, not that I would expect this to be anything like a 2008 scenario, but that residential contractors category lost 1 million jobs in the 2008 cycle, and we're down 3,000 from peak now. So if it rolls over and continues moving in this direction, that would be extremely significant, in my view. I think there's a little bit more that remains to be seen there, just because it's just starting. But given everything that I see in the work that I do, I expect that direction of travel to continue. So if we did in fact peak in September of 24, that wouldn't surprise me, and I agree with you there. But I certainly do watch the contractor space just as much as building, but there's some advantages to the building category from a standpoint of historical analysis.
Yeah, they're still building. I mean, I don't think there's any question about that. When I was in San Diego, the hammers were still knocking, and they've been knocking. I think what's so fascinating to me, Eric, is that we still have this level of employment, and like you say, you're not, looking at U3, but we have more multiple job holders than we've had, since the GFC. But we have so much distress and mortgage. That is what is so interesting to me. And I understand a lot of people just look at the Fed's commercial bank mortgage delinquency schedule. That is just the commercial banks. We all know that they pulled back in mortgage lending due to Basel III. And so it's your non-banks that are doing the majority of the lending. So you can look at someone like Black Knight, but they don't even have the lion's share of the specialty servicers who primarily service the default loans. And then you look at something like the Census Pulse survey, where 10 million people or households said they were behind on their mortgages. And so there's a lot of delinquency out there when we've had way more generous programs than we saw during or post the GFC. I mean, very generous, something my colleagues and I have been documenting on FHA. And yet we're seeing such high delinquency in certain sectors of the market. So it feels to me, and I try to do a combination, all of my work at looking at aggregate numbers as well as kind of local, and look at those two things combined. But there is serious stress bubbling up under the surface when we are at this employment level, which makes me very concerned.
I think that you're spot on, and I think that we're much closer aligned than it may have seemed from our first few back and forths. The work that you've done on the FHA has been spectacular, and there is a lot of stress there, and it is very concerning at these levels of employment. The point that I want to make is that when aggregate employment is not declining, um, and when I say aggregate, I'm specifically focused on the construction and manufacturing sector. It makes up about 22 million jobs. Those two categories are not declining, and those always are going to move first. So I'm still focused there. The point that I'm trying to make is that without job losses, even if the quality deteriorates, the Fed and government agencies have broad abilities to do a lot of the stuff that we're seeing them do, which is some variation of extend and pretend. So when jobs remain intact, even if the jobs are of worse quality, even if the income is of worse quality, the ability for the Fed and for agencies to extend and pretend um, is really high. And I think that since the recovery in 2010, we've never had job losses in construction and manufacturing. And therefore, we've never had job losses in the total, other than the man made COVID period. But if we exclude that, we've never had business cycle related job losses since the recovery in 2010. And as a result, the Fed's omnipresence, in my view, has been overstated in the sense that people believe that they can solve anything at any time. But in reality, what's happened is that we have not had job losses. if we don't have job losses, their liquidity tools and their abilities to extend and pretend and do financing related fixes is pretty great. If we do experience job losses in these categories, it will be the first time since 2010 that policymakers' ability to solve a credit related issue will be on display. And I don't think that they'll be as effective in solving these problems when they're job loss related, when they're actually credit stress related, as opposed to things that they can fix with liquidity or financing or extend and pretend related tools. So that's why I'm so focused on the actual number of these jobs going down, because I believe that that's going to dramatically impair the Fed's ability to actually fix these problems, of which they've been quite successful over the last 15 years. But I think that success uh, is people have become complacent with that level of success. When it's really because, in my view, we just haven't had job losses. And if those do come, their ability to fix those problems, I think, is really going to be put to the test.
Yeah, and I would also say, Eric, what I'm watching very closely is just this current administration's stance on those programs. And I'm watching them close down payment assistance programs. I'm watching them, the loss mitigation I'm watching people they've already used up all the benefits of very generous, way more generous than what we saw during the GFC loss mitigation, and they're using that up, and they're having to sell, or they're going into foreclosure. And so personally, the only thing that the Fed could do to save housing, in my opinion, is to buy mortgage-backed security. And I think that what you have seen is a
I think Melody just had a interruption there. Melody,
I
you
think
coming
we lost
back?
it right at the punchline.
Yeah, I think we did too. It's a shame because she was on a great line of thought, and that's
are you guys
hope.
there?
There you go.
Yes.
Yeah. Okay. Welcome back. Go ahead,
Okay,
Melody.
yeah.
Sorry.
I was just saying, sorry, I was just saying that I think that there are a lot of people that have awareness now that when the Fed bought MBS, that is what created an environment for that home price appreciation. And I think there would be an uproar if they tried to do something like that. And so you're having it shut down on the front end. And I believe that they are about to move in and probably make some cuts on loss mitigation efforts and shut it down the back. And so I guess my point is I don't think that there's anything that the Fed is going to be able to do here, regardless if there are job losses. If they do it, then people are going to see it as completely inflationary. And then the offset is going to be what John and I were talking about previously, that there just might not be the appetite for our MBS anymore, especially if the drama continues around whether or not they're going to be in conservatorship. So, but I take all your other points, and thank you.
And I totally yield the floor to you on all the intricacies of these programs. I mean, you're far more well versed than I am. So I know that they've been doing a few things. I haven't followed the details as closely as you have. I just think that when the job market remains intact from an aggregate perspective, there's just broad ability for uh, policy related fixes. But then the contrary is, if there are job losses like there was in the '08 period, the Fed bought MBS and it didn't really help that much, which is why I really think that this is contingent on if we see broad based declines in the actual number of jobs. Um, but I don't want my position to be misrepresented, that I absolutely see the economy slowing. I think the direction of travel is negative. Um, but given what we've seen in the last three business cycles, not including COVID, you generally see job losses in these narrow cyclical sectors well in advance of the broader, business cycle related downturns that are characterized by the gray bars. And the fact that we haven't seen those yet it makes me believe that we're still actually pretty early in this labor market deterioration. Again, we were seeing these job losses appear in 2006. We were seeing these job losses appear in late 99. We were seeing these job losses appear in 87, 88. These are usually historically this is 18 months, on average before the broad downturn. So that's the only reason I'm
Yeah,
reserved it would be it'd be really uncommon to see the economy devolve into a broader recession,
sure.
um, with the downturn in labor coming from another sector before it comes from construction and manufacturing.
Yeah.
And the fact that we just haven't seen it yet is surprising to me. I mean, especially that the production of these categories has been declining for a while, like the multifamily and things like that. I've been surprised that the labor market in these categories has held up. Um, but I just feel as in the work that I've done, just the most
Yeah.
explanatory variable in these real big downturns is the magnitude of the labor market decline in these narrow cyclical categories.
And I probably wouldn't disagree with you, Eric, on any of that. And what I'm really pointing to is early stress, and what I think may be a compressed timeline this time around. I think that what I'm seeing underneath the covers is that 18 months might get compressed down to 6 once that
Yeah,
drop
it
occurs.
could. It totally could.
Yeah, and so that's really, I think, all I'm saying, because I'm
No,
not
I
disagreeing.
think
Yeah,
I think you could be spot on. I mean, the '08 cycle was somewhat of an outlier in terms of how early those job losses came and how long that held on after that. Going back to a point that John made early on, when we look at the '70s recessions, still was the same sequence. These cyclical categories did decline first, but the lead time was quite short in some of those categories. It was, in the 6 month range. So it's absolutely possible. Absolutely possible.
Well, and that brings me back into the conversation, Kenny and Melody. I'm gonna bring everybody back in here because one of the things I've noticed is that all of the cycles since '87 were during periods of relatively low inflation, not stagnant growth and spiking inflation. At 2006, 2007, we saw inflation begin to spike. '08, mostly in certain commodities. But at this point in time, the dollar was already declining because people were liquidating dollar denominated holdings. Folks, my question for you, Kenny, and for you, Melody and Mr. Awesome, please jump in. If we see an inflationary cycle that scares businesses from wanting to rehire or expand, does that not accelerate the delinquency rates that we're beginning to witness? I don't see a lot of construction jobs down here. I see upper level, high end jobs being competed for as far as the higher end contractors, but the spec builders are getting smoked, and they're probably going to have to start depreciating, cutting prices 20, 30, 40% to move some of these houses they've built in god awful places, thinking that individuals want to live in swamps, etc. We seem to have a distortion, not just based on the income curve, but also geography. And unfortunately, the states with the largest geography are having and demographics are having the impact on the broader economy.
Yeah, I'll take a stab at it. I just think that if we get a stagflationary environment, it's not going to be for the same reasons. Because if you want to just think about the workforce and things like dual income households, which have been around for decades, it is what it is. So, I mean, where's the incremental income going to come from? Is it going to come from your dog's Instagram account? It's just this idea that incomes are going to catch up to the cost of living is just kind of insane to me. And by the way, that's something that you can observe at a very granular level over time. So, yeah, that's my 2 cents. I'll leave it there.
Yeah, John, one thing I was thinking a lot about, just in and Eric, what you were saying about how aggregate income could still be holding up. Production is going down. And we have to talk about it, although nobody likes to, just the immigrant factor. And, what I saw, I've driven over 10,000 miles across the country, flown across the country to these local markets, and every single one of them, basically all this multifamily, all the new homes have been built on the back of this immigrant labor, and how that could possibly be distorting the data. And this is not my area of expertise. So really, Kenny and Eric, or anyone looking at your thoughts, to get your thoughts on that. Like, what could be causing aggregate income to stay high but production down, and then this other wrench?
Yeah, I can speak a little bit from the construction industry side of things, especially the home builder front, and even to the labor situation. All the builders, right, for the most part, have the belief that there's not enough labor out there, and especially for people that have experience. So if a builder, for instance, Lennar, even now they're facing compressed margins, one of the last things that they want to do is lay off or get rid of capable performing people that have knowledge in the construction field. So their superintendents, their purchasing managers, people that they rely on to build housing. Where it becomes a problem for them on the labor front or that cost front is in further compressed margins and worse sales. And we know that they're choosing sales over price because that is their business model. With the decline or some of the changes that we've seen in whether it's legal or illegal immigration and labor, so far, nobody has said anything on public earnings that it's having an effect. In fact, one thing that might be contributing to holding on to some of the jobs that is there is that they're having the belief that if there's less labor, there's more reason to not get rid of their employees they do have. And same with contractors and subcontractors that work for big builders. So I think that we're not going to have necessarily the popular idea of, it's going to cause inflation in wages for construction, because if we're slowing down the amount that we're building and we're building less, there's less need for more employees. So there's less pressure for wages to increase because of that. In fact, it creates an environment where there's potentially pressure for wages to go down again or stagnate, especially coming off 2022, 2023 record wage increases. So they're already dealing with those wage increases that happened in the past, and now we're changing the scenario that they're facing. So that's my take on the labor front, and then even some of the other pressures we're talking.
That you and
yeah,
I
of course,
talked
please.
About before, that I've always just wondered about is, that on these building sites you have the contractors, the subcontractors, and the subcontractors.
Mm-hmm.
Right.
Of course, yes. Subs of subs. Yeah.
Like, who even knows how many people are on a job site? You know what I'm saying? Yeah.
Well, that's the thing. There's probably one person per construction community that knows the answer to that, maybe two, and it's only those people. But nobody else is, above them in an organization is going to know. A division president's not going to know that. A regional vice president's not going to know that. That's not something that they're going to get into. They're not interested in that granular level.
And I guess my point is, because you and I have also talked about, we've heard about people actually crossing back over the border because there is no work, right?
Yes. Very, very much so.
Do we not even know how many people are leaving the industry because they're not even actually being properly accounted for?
It's certainly a possibility. I've seen so many different estimates of how many migrant workers were here. It would be difficult for me to pick a number and say I would agree with one. But I could also say because of that, it's probably likely that we wouldn't have any knowledge of how many have actually left the job market as well.
Can I add a comment?
I'm going to bring Eric back.
Yeah.
Oh, Eric, let me jump in here real quick because I was just getting ready to bring you back up for this. Having some exposure to this field in my past, one of the things I noticed and found out from CBP was there is no tracking of green card work permit issuances crossing the border north or southbound, which really makes an accurate measurement of this size of part of the workforce even remotely possible.
Yeah, I don't have good data or knowledge on the immigration issue and how that's playing into it. I wanted to add a comment about what Mr. Awesome was saying. He was making some comments that were spot on about uh, construction companies and builders don't want to let people go because they have big fear of the labor shortage that we had, and there's not a lot of skilled labor that will be able to replace them. All of that is spot on. I sent uh, a chart to the MacroEdge account. Maybe you could post it in the nest, and if not, I retweeted it, so it should be the first tweet on my timeline. Companies obviously do not want to get rid of labor. No one wants to get rid of labor because it's a very binding activity and it's really hard to get them back. However, you can only maintain the labor if you have the margin to do it. So the chart that I retweeted, which should be first on my timeline, is the aggregated profit margin of the 8 largest home builders. And you could see that before the pandemic, they were running at about a 10% average margin. After the pandemic, because the land values increased, because of the big injection that we had, and a variety of other factors that maybe Mr. Awesome can weigh in on, margins exploded to 20%, which was the highest profit margin in the history of home builders. We've dropped now from 20% to 16%. So directionally, margins are heading down for all of the reasons that we talked about on this call, like production falling while they're maintaining their headcount. But if you look at the raw margin, it's about 16%, which is still higher today than it was at the peak of 2006. So they are holding on to their labor for fear of not being able to replace it, but it's really because they have the ability to do it for now. Only once that margin gets compressed further, and we still need to see more margin compression, and I do think that we will, but builders aren't going to drop their headcount until they're really forced to in the margin space. And it looks to me, based on the aggregate of the whole sector, that there's still a little bit of room there. And it's been mind boggling to me how high these margins got. But it was just a sad reality of the mistake that we made during COVID. And this is kind of symptomatic of many sectors in the economy, but margins exploded to such an extent that it's given these businesses long cushions to withstand declines in production while still maintaining headcount. So I think that they're running out of runway in that sense. But if you just look at the chart, it's pretty mind-boggling how high margins got. And anyone that works on a construction site, I don't, but maybe Mr. Awesome, you have better insight into the contribution of how margins got to be so high. But the data is what it is, and it's just it's pretty mind-boggling.
Yeah, I'd be happy to weigh in there. The majority of it was everybody was raising prices even faster than the existing home market was going up. I measure and track home building cycles as well. I've created what's called the U.S. Home Building Situation Index, and I've broken that down into cycles from trough to trough of inventory and sales peaks. And so going into the pandemic, in 2019, builders had sort of slowed down, and as your chart shows nicely, their profit margin was relatively flat for 5 years there.
Flat, right?
And when COVID reaction hit, they happened to be at a low point for inventory because they had already gone through 2 years from 2017 to 2019 and really into the start of 2020, where they were also seeing some margin compression again, and builders were starting to lower prices. So it's basically the beginning of a slowdown for home builders. And then going into 2021, there was enormous demand for new houses. We had 2% and 2.5% mortgage rates, and people were offering above asking for new builds. And so builders responded by raising prices. Going back to the earlier part of that conversation, at the end of Q3, just the conventionally financed median sale price of a new home got to $494,500, I believe, is the exact number. So for 2 years, it was nothing but margin expansion, even though they were facing price increases, lumber increases, what felt like labor shortages. And I think there's been a lot of what's seen online as well from people posting home inspections, and there's been a lot of ire towards builders over their quality. There's been a lot of good people in the industry that have made great efforts to build quality homes, but the demand was absolutely insane for new homes into 2022. Since 2022, the end of the year, then fourth quarter, home builders have had to use incentives, and they have been facing margin compression ever since. And it's kind of a long timeline for them before things start to manifest in they'll lay people off. To what we both agreed, they've got money invested in these people, and they do not want to lose people that have skills if they can avoid it. So just, I guess, in short, the reason why their margins exploded was they had very few homes that were available to buy at the time, and people were willing to pay more, so they raised prices, and then they went absolutely crazy permitting and starting construction. And as long as those buy downs were working, they were continuing to add product. And now we're seeing the reverse of that, where we're starting to build less, and they're starting to be worried about margin compression and lowering guidances again.
Margins, based on the chart that I posted, have been coming down since the end of 2022. Here we are in the beginning of 25. I've been surprised how slow the margins have been coming down. And have you been surprised by how slow the margins have been coming down in the face of what's been like 2 years of concessions and buy downs? And I also want to highlight in the chart that the margins, it seems historically, can be kind of sticky for the home builders, but they're very leveraged to the actual price. So if you get, broader declines in price, as we saw during the '08, which was a kind of a very extreme example, margins can like implode, just like, uncontrollably, like they went to negative 20%. But have you been surprised how slow it's taken? And do you see that margin degradation kind of accelerating?
I haven't been surprised, but only because I'm in the industry and involved in it. One of the reasons that I think that it hasn't compressed further is because there was some relief in some materials, lumber, siding, roofing. Lumber definitely had a big comeback down from its peaks. So 2023, 2024, builders were able to have some relief on the actual cost to build homes. Where we've seen the buy down incentives has been in the increased SG&A costs, because builders will put that into sales cost, right? They never want to put that into the cost of the home itself. So that goes into selling and general administrative. And that has been increased also since 2022. But now that we're not getting any further reductions in material costs, and in fact, we might have increases with tariffs, I think that's a potential catalyst for home builder margins to further compress even faster than they have over the last 2 years.
Hey, Ulysses, I think I've asked you this before, but in terms of those margins, do they in any way calculate, kind of cost of funds or what they're getting, because those buy downs, they hold that money in escrow accounts for which they're collecting interest. Is that included in the calculation for margins?
So their net margins will always take into account all of their expenses and revenues. Most of the publicly traded builders will segregate costs on gross margins, and they'll have a gross home building margin, and then they'll report net earnings and net margins separately.
Okay.
Well, guys, I don't want to abuse everyone's time. This has been one of the most fascinating discussions ever on MacroEdge. You guys have been fantastic. So I'm going to go around the table. Eric, is there anything you'd like to add to this discussion? And please promote your X handle and your website.
No, this has been great. I'd love to do it again. Have another back and forth. I think that we're pretty much on the same page on a lot of this stuff, and yeah, I appreciated a lot of Melody's comments and Mr. Awesome as well. Um, just go to epbresearch.com. It's the link in my bio, and you can find everything I do. And I'd really love to do this again if you guys are up for it. So thanks for having me.
Absolutely. And if you're not following Eric, his handle on X is at EPB Research. Fantastic data analysis. And look, folks, you cannot get enough information from the various sites. Kenny, I'm going to go to you next because you know Melody's going to be last. I'm going to sit here and ask her the hardest question. So, Kenny, you're seeing a deterioration in residential and construction in one of the hottest areas of the United States. Do you also see the same thing that I'm seeing? And I'm going to hit Mr. Awesome up on this. A little bit of a slowdown due to the retail restaurant crash and burn that seems to be occurring.
Yes. I mean, I do. It looks different across the country, but more or less it's slowing, and it's not catastrophic, but it depends on really the market. So a lot of hand holding this cycle, but yeah, there are definitely some weak parts of the economy, especially the cyclical areas, and it is what it is. So anyway, last thing I'll say is thanks, John, as always, for hosting, and I appreciate your time, Eric.
All right, Mr. Awesome. The one subject, and Eric, you have an open invitation to come back. We have all the fascinating guests we have. You're hearing a sample of just our team talking, and this has been one of the most in-depth discussions we've had in a long time. So please feel free to come back. Mr. Awesome, we didn't even get to the strip mall, restaurant, and retail discussion. What kind of impact are you seeing, especially in the Midwest, regarding the deterioration in commercial real estate? Jesus Christ, X been acquired. Sorry. In your region, and what kind of impact are you seeing on the construction outside of residential, on the construction industry there?
Sure. It's been an incredibly mixed bag. Both downtown Minneapolis and St. Paul have had some serious valuation destruction on their central business district buildings, and have seen buildings trade at fractions of what they had sold for even at the end of 2018, 2019. Interestingly enough, the strip mall retail in the metropolitan area for the Twin Cities has remained a strong point, believe it or not, and has done quite well. In the non-residential construction sector, I'm still seeing a lot of the retailers, they're still going ahead with construction on their projects they had planned for the year. I've yet to see anybody pull any retail or specialty service trade construction projects, whereas we've seen a lot of apartments get canceled. We've seen timelines on residential communities get adjusted. But interesting enough, that commercial portion here is still holding up much better than everything else as far as construction goes.
Fascinating. Folks, you can follow Kenny, by the way, at KennyCap_PhD. Mr. Awesome, also with Kenny and Melody, are part of the MacroEdge real estate team. Please go to macroedge.net/ozone. You can subscribe, get a 2-week free trial. You can also sit there and find out how to access our real estate research, which is proprietary. These guys do a fantastic job. Mr. Awesome is at Mr. Awesome. When him and Melody are not on Fox Business talking about the situation, you can find them here with our team, writing away and contributing to great shows like this. So, Melody, you know I'm going to come to you with a big question.
Oh, boy. Okay.
Oh, boy, yeah. Well, let's face a little reality. You and I go back a long way as far as this goes, back to the 07-08 fiasco and our analysis of Florida and everything else. There was a great story in Commercial Observer about distressed real estate threatening the regional and community banks. And at this point in time, as you talked about with the derivatives, which a lot of these banks speculated in, God forbid what the consequences of that will be. Is that the kind of threats that we ignored in 2007 that eventually cascaded into a larger problem? And are we ignoring it again, where in this current administration, not a reflection of politics, folks, but in this current administration, we appear to be doing a wink and a nod towards financial fraud and shenanigans? There's a lot of danger, like, let's face it, Wile E. Coyote playing with a dynamite and a cigar.
Yeah, I think there's much more danger than back then, John. And I honestly think, that was an awakening for me, being a useful idiot from within the industry, within financial services, within, mortgage specifically, thinking that we had all learned our lesson, and then, becoming disabused of that notion over time by actually looking in the credit quality books of my clients. Because I essentially got out of any role that was close to origination in 2021, and I wasn't that close then. And so, I believed all the credit quality gospel singing that had been going on in the industry, and most of the industry believes it. It wasn't until I really started seeing the stress myself that I had to go really unlearn everything I thought I had learned, go back and look at Dodd-Frank. They had removed in 2021 very quietly the debt to income, threshold. But that's all, that's credit quality mortgage. But I think this is now so pervasive that what happened actually during the GFC is people got a little slap on the wrist. The too big to jail, proceeded to have learned lessons and then just went on steroids. And so I think what most are missing in this cycle is just how much speculation there really is and how that changes things. I think about, it wasn't Michael Pettis, the first person that talked about the bezel, but he talks about it very well, that you think that it's like when, I think it was JP Morgan, and they thought they had silver, and then they go to the vault and it's not there. But, for years that silver sat as an asset, or that fake, the idea of the silver sat there as an asset on the balance sheet, but it's really not there. And so I think where we are in this environment, John, is, be it the small banks, be it the pensions, be it the big banks, honestly, I think they are in a lot more trouble than people understand. We are in a very, very risky environment right now, and far more so than we were in 2007, in my opinion.
Thank you, Melody. And Melody, once again, is part of the team. If you're not following her on X, she's at M3_Melody. Folks, this has been one of our most productive shows as far as conveying information to you on a specific subject. We see a big picture here between the macro, micro, and what's happening in real estate, construction, etc. There's more to come, and you can catch it at macroedge.net/ozone. Get your 2-week free trial. See what we're offering with the writers and the team there. I contribute, I write. Melody, Kenny, and Mr. Awsumb are huge contributors to the real estate section of this endeavor. What we're witnessing right now cannot be parallel to 07, 08, or the 81 or 87. Equity markets are in a unique position, as Six, one of our resident writers and commentator, points out. Don Johnson, our economist. We're looking at a new situation where we've never witnessed a convergence of events in the United States like we've seen before. Change your thinking. Go to macroedge.net, subscribe to the Ozone feature for a 2-week free trial, see what we have to offer. For MacroEdge Radio, thank you to all of our guests. Thank you for all the commentary and questions, and good night now.